Have you ever stared at a crisp $20 bill and wondered who decided how much this is worth? Or maybe you've seen the news talking about interest rates or inflation, leaving you scratching your head about who controls those levers. The truth is, there's no single entity with a giant money printing press in their basement. Regulating money and monitoring the U.S. economy is a complex dance between several government agencies, each with a specific role. Today, we're going to untangle this web and see who's who in the world of U.S. financial regulation. The big kahuna, the Federal Reserve. Think of the Federal Reserve, often nicknamed the Fed, as the conductor of the economic orchestra. Their primary focus is on monetary policy, which basically means influencing the money supply and credit conditions in the U.S. They do this through a few key tools. Setting interest rates, the Fed sets a target federal funds rate, which is the rate banks charge each other for overnight loans. This indirectly affects interest rates you see on things like mortgages and car loans. By raising or lowering this rate, the Fed can influence borrowing and spending habits, impacting economic growth and inflation. Open market operations, this involves the Fed buying and selling U.S. government bonds. When they buy bonds, they inject money into the economy, and vice versa when they sell. This helps manage the money supply and influence interest rates. But wait, there's more. The banking regulators. The Fed isn't the only one keeping an eye on things. There are several agencies responsible for regulating different types of banks. The Office of the Comptroller of the Currency, OCC, oversees national banks, which are chartered by the federal government. The Federal Deposit Insurance Corporation, FDIC, protects depositors' money in case a bank fails. They also regulate state-chartered banks that choose to be FDIC insured, most are. The National Credit Union Administration, NCUA, oversees credit unions, which are member-owned financial cooperatives. These agencies ensure banks are following lending rules, maintaining adequate capital reserves, and treating customers fairly. They basically make sure the financial system is stable and doesn't go off the rails. Keeping an eye on the stock market, the Securities and Exchange Commission, SEC. The Fed and banking regulators focus on banks and the money supply. But what about the stock market and other investments? That's where the SEC comes in. Their job is to protect investors by enforcing securities laws. This includes preventing insider trading, ensuring companies disclose accurate financial information, and generally keeping the markets fair and transparent. Regulating stock exchanges and other market participants, they make sure these entities are following the rules and protecting investors. The watchdog, the Government Accountability Office, GAO. While not a direct regulator, the GAO plays a crucial role in holding the other agencies accountable. They act as an independent, nonpartisan agency that audits government programs, including those related to the economy and finance. They basically make sure everyone else is doing their job effectively. It's a team effort. As you can see, regulating the U.S. economy and money supply is a collaborative effort. The Fed sets the overall monetary policy, while other agencies ensure banks, investment markets, and the entire financial system are functioning smoothly and protecting consumers. So, the next time you see a news report about the economy, remember the complex dance happening behind the scenes. With that said, thanks for watching, and until next time.